Chapter 8, Sarbanes-Oxley, Internal Control and Cash. In this lecture, we're going to talk about internal control, which is probably one of my most favorite subjects to talk about, if you haven't already noticed from my class lectures. What we're going to do is we're going to delve into what are internal controls and some examples and things. And one of the first things we need to understand is what employee fraud is. Employee fraud is the intentional act of deceiving an employer for personal gain, taking money, taking assets, all types of information, anything. You could steal anything from your employer for personal gain, and it is considered to be employee fraud. Some of the elements of internal controls that we need to look at here is management's responsible for designing and applying 5 elements of internal control to meet the 3 internal control objectives. These elements are as follows. We have the control environment, risk assessment, control procedures, monitoring, information and communication. So let's take a look at how this applies, so to speak. Oh, little technical difficulty there. All right, so internal control elements, you've got monitoring. We monitor as management and as owners to look at what the situation is. By monitoring and constantly evaluating things, we're able to gauge and look at any type of situations that either are running well or maybe not running so well. We also need to assess our risk. Risk can be internal risk, external risk, and we need to make sure that we are looking at all aspects of everything involved. And then we need to look at the control procedures of how to control the risk that are at hand. We then can also look at our control environment. What exactly can we control? Through this, we're looking at information, communication from management to the business, from management to the employees, and from the business to our external users, which could be our creditors, our investors, shareholders, stockholders, things like that. So there's a lot of threats that we need to look at and a lot of ways that we need to analyze this, and good management is the place to start. Without a good manager, it's going to be really hard to gauge some things. So let's talk about this control environment and what we're going to be doing here. The control environment is the overall attitude of management and employees about the importance of controls. 3 factors influencing a company's control environment are as follows: management's philosophy and operating style, the company's organizational structure, and the company's personnel policies. Point blank, management's philosophy and operating style plays a major factor in how employees will operate and what they do. The company's organizational structure lets everybody know who's the boss and who are the subordinates. And the company's personnel policies let the employee know how they're supposed to act at all times, and if there's a problem, who they need to go to. Now, control environment, you've got your CEO, you've got the organizational structure, which then leads to the employees. You have your personnel policies and your management's philosophy and operating style. And this is all supposed to work hand in hand because people are your most valuable asset within the company, but can also be one of your most control risks that you have to deal with, because as humans, we don't always follow the rules like we're supposed to. Control procedures provide reasonable assurance that business goals will be achieved. Control procedures include the following: competent personnel, rotating duties, and mandatory vacations, separating responsibilities for related operations, separating operations, custody of assets, and accounting, and proofs and security measures. So competent personnel, this is all in your hiring. I know a lot of people have probably heard the term negligent hiring and retention, but negligent hiring is hiring somebody who is not competent to do the job. And unfortunately, we probably all have worked in a company where this has been the problem. Rotating of duties is basically like cross-training, and everybody needs to know how to do another job that's related to theirs. And mandatory vacations allows people to disengage from work, have a little rest and relaxation time, and also opens the door for that rotation of duties and allows us to implement that policy. Separating responsibilities for related operations is crucial in large businesses. In small businesses, you're not going to have such a separation because you don't have the human factor and enough employees to do this. However, in large corporations, separation of duties and responsibilities is mandatory. The person creating the invoices, sending out to the customers, is not the person who brings the money in from the customers. The person who initiates the bills in the system, or not the person who signs the checks. Those are your separations. Separating operations, custody of assets, and accounting. Departments are a big deal. Who's in control of what? You have the accounting department. You have the sales department, the marketing department. Everybody has to have their own set of operations and their own custody of assets and be accountable and accounting for these things. And then to have proofs and security measures, this is simply just aligning your policies and procedures to let everybody know what's going to happen. For instance, if I have a cash-based company and I receive a lot of cash, stands to reason that for every cash transaction, the customer gets a receipt and the company gets a receipt. This provides the paper trail for cash transactions, because cash will be one of your areas that people will try to fraud you with. Again, some very competent control threats here. Competent personnel, rotating duties, mandatory vacations. Again, separating of responsibilities, things like that. We want to make sure that we understand all of our control threats that we have to deal with. Monitoring is a big deal. We want to monitor the internal control system used to locate weaknesses and improve controls. If you are monitoring, let's say you've got accounts receivable and you've got 1,000 customers, pull 100 of those accounts and look at them. Make sure that everything was done correctly and discounts weren't given when they weren't supposed to be, and money was brought in, and there were no adjustments and things like that. And that's the way to monitor things. Do the same thing for your vendors. Do the same thing for payroll. And as long as you're monitoring on a consistent basis, you should be able to locate any weaknesses or weak links in your policies and procedures there. Monitoring often includes observing employee behavior in the accounting system for indicators of control problems. Employee behavior we'll talk about momentarily, and can actually be a pretty big issue in certain cases. So warning signs of internal control problems, warning signs with regards to people. Abrupt change in lifestyles without winning the lottery. Somebody who constantly complains about their bills and all of a sudden buys a new car might look a little fishy, especially if something might not be so accurate with what they're doing at their job. Close social relationships with suppliers can be a problem. You could be having an issue with kickbacks or bribes. Refusing to take a vacation. Everybody needs to disengage from their job. That should be mandatory, and if somebody's refusing to take a vacation, you need to look into what they're doing. Frequent borrowing from other employees, borrowing money, borrowing items. This can be a problem. If somebody is borrowing money and having a hard time paying their bills, a lot of companies look at this as a situation where they might be more apt to commit fraud. Excessive use of alcohol or drugs. While alcohol and some prescription drugs and things like that are not illegal, the abuse of them can cause problems at work. And then if you have somebody using illicit drugs like crack, cocaine, heroin, things like that, you need to make sure that you first follow the policies of getting them help and then removing them from a position where they could commit fraud against you until they are back on track with their life. That is to ensure the company is not going to have a problem. Now, some warning signs within your internal controls within the accounting system. Missing documents or gaps in transaction numbers could mean documents are being used for fraudulent transactions. Any unusual increase in customer refunds, the refunds may be phony. Differences between daily cash receipts and bank deposits could mean somebody's pocketing money. Sudden increases in slow payments, employee may be pocketing the payments. And a backlog in recording transactions could be an attempt to delay detection of fraud in certain situations. So this is an interruption to the flow of processes, and anytime something like this happens, it needs to be investigated fully. Now, internal controls can provide only reasonable assurance of safeguarding assets, processing accurate information, and compliance with laws and regulations. This is due to the following factors: the human element of controls and the cost-benefit considerations.